All right, ladies and gentlemen, colleagues, wherever you are, good morning, good afternoon, good evening, depending on where you are, since this is an international platform. Welcome to our webinar, which is hosted by the Banking Virtual Forum. Today it's on navigating political risks, strategic resilience for financial institutions in an unstable world. But first, let's just look at some housekeeping items. Verbal capabilities have been turned off. For those of you who normally attend, you already understand that. And questions and comments should be submitted in the Q&A box. And then all questions will be answered at the end of the presentation. Recording and the presentation. This presentation is being recorded, and you will receive a recording if you registered for this, even if you haven't attended. So thank you for that. And then a disclaimer note. There is a disclaimer note, disclaimer that we normally have to let you know. The opinions expressed in this presentation and even in the Q&A sessions are those of the authors, not necessarily reflecting the policies of the IAA. So please take note of that. Now, let's get into it. And for us to do that, I am going to introduce our speaker, Lawrence Hababe. Lawrence, some of you would have already been in one of the webinars before, but Lawrence is an advisor on systemic risk, resilience, and geopolitical uncertainty, working with financial institutions and insurers. Over the past 15 years, he has contributed to global institutions, including HSBC, Murex, and ABN AMRO. He is the originator of the Risk Flux Framework, formerly cited in the British Actuarial Journal as a regulator-aligned approach to operational resilience under FCA and PRA guidelines in the UK. This innovative framework reconceptualizes risk as a kinetic force measured through velocity, acceleration, and jerk, enabling institutions to anticipate cascading shocks with greater precision. In addition to Lawrence's advisory work, he leads the Geopolitical Risk in Finance Executive course with Risk Learning, or risk.net, bridging quantitative resilience modeling with geopolitical foresight. He also serves on the IFOA Risk Management Board, chairs the Black Swan Insurance Working Party, and contributes regularly to academic and industry publications. Beyond those roles, Lawrence is a co-member of the United Nations Foundation ASRA Network Accelerator for Systemic Risk Assessment, collaborating on cross-sector initiatives to strengthen global resilience against emerging systemic threats. So please help me welcome Lawrence with this introduction. You can see that he's very experienced in this topic, and I hope you will enjoy the topic because it is also at the core of what actuarial professions do, because you need to manage risk, you need to manage capital, you need to manage liquidity risk, market risk, a whole lot of risk we need to manage that are affected by geopolitical issues arising. So I am going to hand over to Lawrence. Lawrence, I hand over to you, and thank you very much for being with us today.
Thank you, Michael, for this introduction, and good morning and good afternoon, everyone. And thank you for joining this IAA presentation on navigating geopolitical risks. I'm Lawrence Hababe, and today we'll explore how financial institutions, bank and non-bank financial institutions, insurers and reinsurers, and pension funds can navigate this geopolitical risk landscape and build resilience in an unstable world. As you can see on the first slide, we'll cover sort of in the agenda today, we'll cover some key pillars. First, we'll start by describing what is this new geopolitical risk era. We'll give a very brief introduction to what is geopolitics, why is it different now, why is it rising, where are the hotspots that we need to keep track on, because potentially they can lead to conflict and the more complex conflicts. We then move into talking about resilience and governance, the implications for financial institutions, banks, and insurers. And then we will end by using practical tools like stress testing and scenario analysis in order to develop those scenarios to take into account a wide range of geopolitical risk issues. But before we dive into the evolving geopolitical risk landscape, let's just cover the basics so that we set the flow before we dig deeper into what is this new geopolitical reality. Well, when we talk about geopolitics, I mean, we need to understand what do we actually mean by geopolitics. I mean, geopolitics have been around for quite some time, but lately, I would say since about 2017, it's becoming used more and more and more. I mean, what's the difference between geopolitics and politics? Well, geopolitics is derived from the Greek word ge and politique, meaning the politics of the earth. It is basically, it studies the strategic value of states. And their sort of power relationship by analyzing many dimensions, including the politics. The most important component of the state is the geography, the demography, and economics, and how they all interact together in shaping the state's foreign policy. Not just the state's foreign policy, but that strategic value by which other states sort of perceive this particular state. And the reason for that, some states have a higher strategic value than others because of, for example, the abundant resources they have, whether it's sort of natural resources like agricultural land or perhaps oil and gas and gold. Other states will have strategic value because they have access to important trade routes that connect continents together, whether they are sea or land routes. So the strategic value of states is very, very important. And that is one of the main drivers of basically what you call geopolitical tensions. But geopolitical risk means these particular events, they come in a range of triggers. And geopolitical risk is one of those systemic risk triggers. We're not saying that it is itself a systemic sort of, it causes systemic sort of events, but it can be a trigger to sort of systemic events when it creates cascading consequences. These events, for example, outright war, terrorism, and state tensions, they do disrupt international relations. They act as systemic risk triggers, and they impact the strategic objective of financial institutions and by testing their operation and financial resilience. Geopolitical risks come in a range of triggers. They can be outright conflict, they can be regional conflict, they can be state-sponsored cyber attacks. So they do come in a variety of triggers. They have certain characteristics. So they are sudden events, meaning we don't know when they happen, where they happen, or how they happen. They are interconnected and complex because you have to take into account the links between the politics, economics, and financial systems across different sort of regions and jurisdictions. And sometimes they do have a large impact. So they can cause direct losses to property infrastructure or through investing in, let's say, financial assets. But how can we use this information to really give a definition for geopolitical risk that is sort of pertinent for banks and insurance companies? Well, we define it from an actuarial perspective. And we say geopolitical risk is the expected and unexpected losses that arise on investment portfolios, right? Or investment portfolios, of course, for insurance companies. And these investment portfolios, they cover a wide range of investments in different asset classes. Could be equities, could be fixed income corporate or sovereign bonds, could be foreign exchange, could be commodities, could be property. So it is the expected and unexpected losses that arise on investment portfolios or foreign direct investment investment, meaning that capital you pump into holding companies or greenfield investments or mergers and acquisitions through different subsidiaries, or losses that arise on upstream, downstream, and direct exposures. Your upstream exposures could be the exposure you have as an insurance company to your clients, to your supply chains and counterparties. Your downstream exposures could be to your clients, and direct exposures could be sensitive to a wide range of geopolitical risk. For example, your subsidiaries, your infrastructure, your personnel, your data centers. So these are the expected and unexpected losses that arise on these particular exposures, driven by a wide range of geopolitical risk factors, such as we talked about outright war, regional conflict, cyber attack, and some geo-economic tools, for example, tariffs and sanctions, in addition to political risk factors. And political risk factors, these are risk factors that arise from within the state boundaries. They don't come as threats from outside. For example, coups, labor strikes, and civil unrest, in addition to any sort of action that is directly related to government. So, for example, transfer and convertibility restrictions of profits for subsidiaries cannot basically repatriate their profits in hard currency and sort of transact it outside of that country due to government restrictions. Could be a breach of contract, could be non-honoring of financial obligations. So these particular events, when they do happen, they impact institutions' financial and operational exposures, and they act as amplifiers to existing financial risks such as market, credit and counterparty, liquidity funding, lapse, and claims. And therefore, they need special attention. But why is geopolitical risk rising, and why is everyone talking about it? That the next decade is going to be really volatile and complex and unambiguous. In order to really answer this question, this would require many hours of basically providing the premise for why the world is changing, because we need to really go back in history for 80 years and look at what started all of this, what pundits call the world order. And you can think of this particular world order simply as the collection of norms and values and legal texts that regulate the relationship between countries on the international stage. Now, that's been protected and promoted by the United States and the Allies since the Second World War. Now, that particular world order is coming under threat from states and non-state actors who disagree with it for various reasons. But it is rising because we have what we call strategic rivalry between two superpowers, particularly in areas such as resources and technology. So the strategic rivalry between the United States and China is driving part of it. The fragmentation in global trade, the resource nationalization, the energy transition, and weakening of multilateral institutions. And these are just a subset of drivers that's driving this change and this sort of new era of geopolitical risks. Now, what are the top 5 sort of flashpoints that we need to consider? For example, we need to think about events that are taking place, let's say, in Taiwan and Greenland, and why these are important, because they can involve big countries, and these big countries can face each other directly, and it creates conflict. So whatever happens in Taiwan and Greenland can be a potential trigger for outright conflict. Development that takes place in the Middle East, for example, what's happening in Ukraine and the expansion of NATO and all of that, they can act as what we call triggers to broader conflict. For example, other flashpoints we need to consider, you have the Arctic resources and travel routes, basically, that are more significant than your traditional routes through other parts of the world that are rising due to climate change and the thawing of ice in the Arctic. So all of these can lead to potential conflict. So what can we, any single event of those, if it leads to an outright conflict between big superpowers, it can lead to market drops of a significant amount. So what do we need to do about them? Well, we need to bake them into our enterprise risk management and strategy. This new reality that we're talking, as you see in the first slide, we call it the new geopolitical reality. So what is it exactly? Well, for years, we had geopolitical risk. It was considered a secondary concern for financial institutions, something it could be considered as a line item to be managed, but not as a central driver of strategy. That era, according to geopoliticians and political analysts and even presidents of state, they say that this particular era is now over. We now live in an interconnected and volatile world where political events, from trade disputes, sanctions to regional conflicts and disruptions to supply chain fragmentation, have immediate and profound impact on our businesses. This new reality presents complex challenges for all of us in the banking, insurance, and actuarial fields because they can trigger unexpected market volatility, impacting our investment portfolios, and they can create significant regulatory and compliance hurdles and expose us to new vulnerabilities in our operational resilience. So ignoring these risks is no longer an option. In addition to that, in addition to the evolving geopolitical risks, we have regulatory fragmentation, which is adding more to this sort of world that we can describe by what they call a world that is a volatile, complex, uncertain, as becoming more ambiguous. We used to think that regulation was quite uniform across different jurisdictions. There were clear, stable rules. But today we face patchwork of diverse and often conflicting regulations across different jurisdictions. So you have a new sanctions regime in one country that can contradict trade agreements in another, making it a minefield to navigate. This complexity doesn't just create compliance challenges, it increases costs it increases costs to business and impacts our operational resilience. In addition to that, we have systemic vulnerabilities. The financial system globally is deeply interconnected. A shock in one part of the world likely can lead to propagating in ways that we don't really yet understand. So, for example, take a disruption to the Strait of Hormuz in the Middle East, which is a very important waterway and a choke point for transporting about a quarter of the world's daily energy needs. A disruption there could lead to a disruption to in the major commodity markets. In addition to that, you can think of a retaliatory cyber attack on a major institution can all ripple through the entire system, meaning that the risk doesn't just sit there. It flows, it propagates, and that's why it's becoming more complex because of this interconnectivity, the operational financial interconnectivity that allowing those risks to propagate in ways that we don't really understand. So what is the solution? Well, we need the answer lies in strategic risk management. And that means that we can no longer treat geopolitical risk as an external, unpredictable factor. We must integrate it into our strategic planning and in our operational resilience risk assessment. That means we need to enhance our operational resilience by making our systems and organizations robust enough to withstand shocks, to withstand these geopolitical shocks. In essence, we need to shift. In order to deal with these type of risks, we need to shift our mindset from simply reacting to those events to proactively building resilience against them. One of the manifestation of geopolitical risk that's been a headache, and it's quite becoming more and more important, is cyber risk. These events are being used by state and non-state actors, and they are sponsored cyber attacks. They act as hybrid warfare tools. What they do is they target financial systems and critical infrastructure. And the object here is to disrupt whole economies and assert power. These events, these ain't just opportunistic hacks, they're precision. You can consider them as hybrid warfare, precision strikes. They use highly sophisticated ransomware and malware that's custom built for industrial control systems and operational technologies, meaning this malware is used not just to steal your data, but the object is to disrupt, degrade, and even destroy physical processes. So why is it important? Well, the attacks is not just an attack of a ransomware on a financial institution, a direct attack. It could be an indirect attack. It could be an attack, for example, on the supervisory control and data acquisition systems that are used in, let's say, the utilities section to manage your power grid, to manage your transit networks, to manage your bridges, even the financial system. So it's not only about a direct attack, could be an indirect attack that basically exposes the financial institution, whether it's a bank or an insurance company, to a cyber attack. Imagine, for example, a cyber attack on a central clearing counterparty that deals with clearing derivative transactions between financial and non-financial institutions. Imagine an attack on a critical third-party service provider that's providing the payment system or the iCloud. So it could be coming directly or indirectly from a wide range of critical dependencies that these financial institutions depend on. In terms of regulation, well, regulators aren't waiting for the next crisis to happen. They are enforcing cybersecurity resilience and weaving it straight into risk and solvency frameworks. That means globally, we are seeing harmonized standards emerge. For example, Basel for cybersecurity, DORA. These are all frameworks that enable actuaries to deal with these kind of disruptions, enable them to quantify them and add them into their capital and solvency frameworks. Some real-world examples, what we call some wake-up calls of these particular precision strike attacks. We can look at Ukraine, for example. Just look at what happened in 2015, 16, and 22, when there was a state-sponsored cyber attack on the Ukrainian power grid that led to over 500,000 people losing power. Look at, for example, the 2020 solar wind supply chain attack, which compromised 18,000 networks worldwide, exposing critical infrastructures from utility to manufacturers. Look at last year's CrowdStrike meltdown or CloudShare. Of course, the 2024 CrowdStrike wasn't a malicious attack, but it was a software update, but it caused a lot of damage. It impacted and infected 8.5 million Windows systems worldwide, with cost exceeding north of $5 billion. So cybersecurity is the new frontier of geopolitical risk, and the combination of digital attacks with physical damages amplify this particular risk. As actuaries, we are uniquely positioned to model it and mitigate it. So to conclude here, we need to treat cybersecurity not as an IT item anymore. It is a proper geopolitical tool. State actors are targeting banks, insurance companies, and markets. Regulators are tightening. We're asking for more capital due to that increase in the frequency and severity of these threats, and the sophistication and the increase in the space of attacks. So we need proactive measures like intelligence sharing, which is essential to mitigate these risks. Next slide. In today's volatile geopolitical landscape, traditional models often fall short in capturing the dynamic and accelerating nature of threats to operational and financial resilience. That's why I've developed the risk flux framework, which is a more kinetic approach that models risk through kinetic measures. This framework empowers financial institutions to align response with risk momentum, ensuring continuity amid disruptions like sanctions or war or cyber attack. But let's go back a little bit and talk about traditional risk. Why is it not complete? So in the traditional risk perception of risk, we use in the traditional risk perception, we view risk as a static variable, meaning we have it a part of a list of threats and vulnerabilities. We tend to quantify that or summarize it in probabilistically using an impact and likelihood score. And then we compartmentalize that into separate silos. Could be financial, could be operational, could be geopolitical. But this leads to a reactive behavior when dealing with those risks. That means the way we do it is we identify the risk and isolate it, we monitor it, we apply linear mitigation techniques, and then we repeat the process. Again, if we take, for example, the one way we treat with those risks under the traditional view, let's take a geopolitical risk. That would be the risk class. Under the risk class, we have an event, let's say a disruption to the Strait of Hormuz. Under the current geopolitical risk environment, the probability of that event is very likely. We tend to think in terms of the impact. If you are a supplier that depends on supplies coming from that particular region, well, what can you do? What the linear way of thinking about it is to diversify supply. Well, that's not really sufficient to deal with these extreme events in a highly interconnected world. So the risk flux framework, it reconfigures the perception of the risk and pushes for a kinetic view. We don't treat risk as a fixed point. It doesn't just sit there. It actually flows, propagates. The risk itself is dynamic. It moves across systems. It accelerates across financial and operational dependencies. It accumulates at certain financial and operational exposures, and it moves across domains. The risk flux framework, it provides the intellectual scaffolding by providing the mental tools to navigate this uncertainty, by providing a feed forward and feed backward risk consequence analysis. And that is that we use these mental tools in order to do the mapping. We map the top-down cascading consequences of the potential event across different domains, the interaction of the cascading consequences, and how these evolve in time and affect a financial institution or an insurance company's bottom line. So the bottom line for an insurance company could be the investment portfolio, could be the different lines of business, aviation, credit, trade credit, could be marine insurance, ultimately impacting the asset quality, impacting the funds flow of insurance company, impacting the funding and the lending and the solvency capital ratios for banks. So in the risk flux framework, we shift the question when we focus on not we shift the focus from answering what if the risk crystallizes to when and how fast the risk propagates and starts impacting our business. And we use the kinetic principles, the velocity, the acceleration, and jerk. And what we mean by velocity, we mean how fast is the risk moving or spreading. The acceleration, how rapidly is it intensifying? The jerk, which is a very important component here, is when the risk propagation or when the risk consequences, the velocity of these consequences are higher than the ability of the institution to deal with these consequences, it triggers the institutional latency, or what we call a systemic risk collapse. So by treating risk as a dynamic, evolving force that moves through systems, it accelerates through financial and operational dependencies and accumulates and moves across domains, we need to, that means we treat it as a flow, just like water. It flows, it accumulates, it amplifies, and that means that we don't need to only focus on the direct impact of geopolitical events or any extreme risk event. We need to focus on higher order impacts, and we can understand those through mapping the propagation pathways. So by understanding the flux, it allows not only to observe the risk, but design for it and design those mitigation strategies. So this is crucial for operational resilience, cyber risk, and catastrophe modeling, where timing determines loss magnitude. So let's take an example. For example, how do we apply this framework to a geopolitical event? Imagine, for example, a sanctions shockwave. So the sanctions themselves, this is a systemic risk ignition trigger. Imagine a sudden sanction package imposed on a major energy exporter. So what is the first order motion here? Because we said in the risk flux, we're not interested in where the risk itself sits. We're not interested in its existence, but we're interested in its motion. Well, the first thing that you will see is that within hours, shipping insurers will start pulling coverage. That can lead to tankers sitting idle at ports. That could lead to energy prices hiking. So now the movement is fast, but still linear. As time progresses, and this event sort of accelerates and moves, There is second order motion, meaning that by the time the next day arrives, financial markets react, they amplify the shock. Banks and insurance companies who have derivative transactions referencing energy products will start getting margin calls. They need to raise capital that can lead to facing cascading stress to raise capital and liquidity to meet these margin calls. Now the system just doesn't move; it's actually speeding up, and then comes the jerk. And this is what we see when you have these particular shocks, is that when a particular event triggers this shock and the risk starts propagating and the institutional latency is lower than the jerk, the speed of the cascading consequences, it triggers what we call systemic risk collapse. So in this particular example, if let's say the bank or insurance company had huge exposures to certain risk factors that is impacted negatively by the event, let's say in this particular case, energy, their counterparty credit risk will rise due to a potential default of the underlying or a rating migration, and that leads to more margin calls, more capital to meet those margin calls. If the speed at which the margin calls is not met, or the speed at which liquidating assets to meet those margin calls is lower, then that can trigger the collapse of the institution. And because the market and the financial market or the financial system is highly interconnected, it could lead to broader implications as well. This is what I mean by the risk flux. So it's not just a single event that we're interested in, it's the motion through the system. And resilience isn't about predicting the sanctions themselves, really. It's about designing adaptive risk strategies for institutions so that they can absorb the velocity of the event, they can withstand the acceleration and adapt when the risk jerk hits. So how do we do that? Well, we need adaptive risk strategies. So it's no longer optional that we just focus on the traditional way of thinking about risk. We need to augment it with these sort of adaptive strategies and look at the propagation pathways, higher order consequences, and with a particular focus on trying to understand the institutional latency of the institution itself. And this shift, of course, to adaptive risk strategies ensure not just survival, but continuity, credibility, and trust in the face of accelerating disruption. Next slide. In today's world, geopolitical risks directly impact firms' stability and profitability. Again, whenever we talk about geopolitical risk, we have a range of geopolitical risks. We have a range of exposures. We have a range of transmission channels, the real economy, financial markets, or direct exposures to the infrastructure, personnel, or my downstream and upstream exposure. So at the end of the day, we need to link all of these potential geopolitical events to how they impact the bottom line, the profitability, and the stability of the institution. So in order to not just survive, but thrive, in order to do that, we need to answer that the answer for strategic resilience lies in two key areas. One, to have a robust geopolitical risk governance, and two, strategic risk underwriting. So let's first tackle the robust geopolitical risk governance. So what do we mean by that in order to deal with those with a wide range of geopolitical risk issues? Well, first let's look at the foundational element, aligning governance with risk. So a robust governance framework is the engine of resilience. It must be dynamic and not static set of rules. And that means geopolitical governance framework must actively match the geopolitical landscape, meaning when you understand your exposures, when you understand the different transmission channels, how a geopolitical shock can impact your upstream, downstream, direct exposures, your investment portfolios, your business lines, you need to also take into account the emerging threats and not just the ones that you know. We can't just react to a crisis. We have to anticipate and prepare for a range of geopolitical events. Second, we need effective stakeholder communication. And that requires transparency. So there needs to be transparency and communication between the different actors, the boards, the regulators, and other shareholders. And they all need clear, consistent information to make informed decision. And in order to arrive at that informed decision, we need to have a robust framework that gives us robust geopolitical risk analysis. From that geopolitical risk analysis that tied directly to our exposures, to our business model, to our risk appetite, and risk profile. We need to arrive at the geopolitical risk assumptions. Once we arrive at those geopolitical risk assumptions, we can use them to make geopolitical risk judgment that is beneficial for the institution. And therefore, we need this clear, consistent information flow between all these actors to make those informed geopolitical decisions. This builds trust and ensures that everyone is on the same page during those crises that are triggered by a wide range of geopolitical events. Third, we need Can you see the slides? Can you see the changing in the slides?
Yes, all is good.
Okay. What about third? We need adaptive strategic frameworks. And what does that mean is that we need to move beyond static risk assessments, and we need to augment our static risk assessment with dynamic modeling, taking into account time-aware scenarios. This allows us to ask very important questions. So, for example, what if sanctions are imposed on a key partner? What if a major supply chain is disrupted? These simulations prepare the institution to respond effectively to these geopolitical shocks. And fourth, we need cross-border coordination. In an interconnected world, geopolitical risks don't respect borders, and therefore your governance framework must make sure and support regulatory compliance and risk alignment across all international operations to avoid blind spots. So what is the payoff if you sort of align your governance, have a robust risk management framework, have adaptive strategic frameworks? Well, the payoff is very clear. Is if you have these sort of robust processes in place and frameworks and policies, then you are able to survive a geopolitical crisis, and that means that you are able to recover faster, you are able to maintain client trust, demonstrate stability to both regulators and investors. So to conclude, here, geopolitical risk is not any longer a tail event or what we call a black swan event. It is a fundamental part of the business landscape. It requires strategic agility enabled by a robust framework. It is a key driver that can turn the challenges into opportunities. Next slide. So in this particular slide, we want to talk about what are the challenges for insurance underwriting in high-risk areas. So that means that we need to now move the talk from looking at the macro picture to the micro picture. So strategic risk underwriting under a world that is described as highly volatile, uncertain, complex, and ambiguous. This is where we operationalize resilience. Geopolitical threats directly affect the profitability of investment portfolios and business operations. So the challenge for high-risk regions is to understand how these events trigger our risk factors. So, for example, there would be for insurance companies who are operating or underwriting in conflict zones or unstable markets, these present unique challenges. One, they need to manage increased claim amounts and lapses, for example, or they need more clarity regarding war clause exclusions in policies, which directly impact the geopolitical risk assessment and pricing. Second, we need scenario-based underwriting that takes into account these timing thresholds. So we cannot do that by relying completely on historical data alone. So we need scenarios-based underwriting that involves using geopolitical intelligence and predictive analysis to anticipate those threats and adjust pricing proactively. So it is no longer pricing risk based on past performance. It has to be based on future possibilities. We need to also understand the regulatory and market impacts, and that means these geopolitical events like sanctions and trade disruptions have cascading ripple effects that impact an institution's or a bank or an insurance company's exposures, but they also have different transmission channels. And these transmission channels can be through the real economy. For example, they impact in the immediate, medium, and long term. They impact broad macroeconomic variables, for example. They can impact growth. They can impact inflation. They can impact consumer behavior. And these are the risk factors that we use to set our actuarial assumptions. So we need to be aware of how these events impact those variables that goes into our actuarial assumptions. They go into computing future solvency capital ratios for asset liability modeling. They also transmit, or these events transmission and impact the exposures through capital markets. They change the behavior of foreign direct investment, the capital pumped into, let's say, equity markets or local domestic stocks and bonds, portfolio investments. And they have an impact on all these financial risk factors, whether they are the market risk or the counterparty credit risk, the credit risk, or the funding and liquidity risk. And they also have a direct impact on the institutions' infrastructure. They can impact, for example, personnel, they can impact buildings, they can impact data centers. But ultimately, we need to look at the exposure, the range of geopolitical risk issue, the sensitivity of our exposures to different geopolitical risk issues, and then we need to link it back to what really matters, the asset quality that we hold for ALM modeling, the profitability, the funds flows, the funding, bank funding patterns, lending patterns, and solvency. So they can they have a wide range of impacts that we need to really understand. And lastly, so we need to balance risk and resilience. Ultimately, effective underwriting is a balancing act. It requires a clear understanding of a firm's risk appetite, while also ensuring that we maintain operational resilience and regulatory compliance. So in this unstable world, strategic governance and strategic underwriting are not just best practice, they are necessities. So by integrating dynamic governance frameworks with proactive scenario-based underwriting, banks and insurance companies can build resilience needed to protect their capital, maintain their reputation, and turn geopolitical challenges into a competitive advantage. So the underwriting, in conclusion, underwriting in risk regions is tough, and we need to understand the behavior of different business operations and the how these events, geopolitical events, impact the claim behavior, the claim experience, how they deal with the war exclusions, and how to shift to scenarios and analytics that price accurately these particular events. Next slide. What are the range of impacts of geopolitical risk implications for financial institutions? But in order to answer this particular question, I don't really want to focus on what's on screen. We need to take a concrete example and look at the range of impacts from a recent crisis. So let's take, for example, the war in Europe between Russia and Ukraine. So how did that impact, for example, Western financial institutions who were operating in Russia? Well, first, it led to a heightened political risk. This heightened political risk led to Western financial institutions struggling, for example, to sell Russian subsidiaries. That resulted in losses of north of $150 billion. For example, British Petroleum lost $25 billion in investment. These geopolitical risk events, they also lead to financial risks. The sanctions or banking sanctions impacted the sovereign and corporate bonds issued by Russia. If you are a Western institution who had direct exposure to Russian debt, whether the corporate or sovereign, you made huge losses. If you are a Western institution who had an indirect exposure that references Russia's interest rate market through some interest rate swap with another financial institution, you had losses. So they also amplify financial risks. These geopolitical events impact liability risks. For example, they raise property claims and trade credit and political risk insurance. They also had a physical risk impact. So the air travel ban by Europe and the US on Russian aircrafts led to huge aviation insurance losses that they are still trying to sort out right now. They also led to economic risks. Global trade disruptions, coupled with geopolitical instability in the Middle East, led to the closing of very important choke points for transporting global energy that caused insurance companies who provide maritime insurance to suffer huge losses. They also led to export control, and these are restrictions on energy, oil, gas, and critical minerals that led to trade credit insurance losses. So the impact of these events, the most extreme, like say war, they have a huge impact, and we need to be able to understand all of these and look how they impact our bottom line. So for financial institutions, geopolitical risks impact markets, and this in turn impacts the insurance investment portfolio and business lines. They also impact banks' trading and banking book. In this particular slide, we can see how geopolitical risk impacted global equity markets. We can see that during the Russia-Ukraine war, what happened to it during the Liberation Day speech by President Donald Trump when he applied tariffs. We can see what happened even during the 2008 financial crisis. This chart shows how geopolitical risk events spike equity volatility. Look at the drops during a crisis like the 2008 or Ukraine war. Next slide. Also, you can see how they impact the foreign exchange rate. I mean, you can have a direct exposure through having an exposure to, let's say, an asset priced in the domestic currency, or you can have an exposure through different foreign exchange swaps, FX swaps or cross-currency swaps or whatever, through counterparty credit risk, where a geopolitical event might impact that. So here you can see how FX rates swing widely with geopolitical events like Brexit or wars that cause sharp depreciation affecting international portfolios. Next slide. Impact on global financial market interest rate. We see here swap rates, the 5, 10, and 20 years. And also in this slide, we see that interest rates react to shocks, geopolitical shocks. They spike during crises. This impacts, of course, our actuarial assumptions. It impacts banks' trading and banking books and the assumptions they use to model their risk-weighted assets. And they also impact insurance companies' long-term liabilities. So to summarize, what are the key challenges for financial institutions? Well, financial institutions, what they need to do in order to deal with geopolitical risk, they need always to have strong capital and liquidity. They need to have robust geopolitical governance in place. They need to have good operational flexibility to deal with geopolitical events that impact their business operations or their subsidiaries or their personnel or their infrastructure. They need strong IT systems and cybersecurity to basically react to any cyber threats. And they need to diversify. And that is required because these geopolitical events, they lead to disruptions in operations. They lead to disruptions to operations. They also need to deal with fragmentation and regulation and volatile markets. And all of these would require adaptive strategies and a comprehensive view of how geopolitical risk affect their institution. So to conclude here, at the end of the day, geopolitical risk cannot be avoided, but it needs to be managed and managed well. So what about capital management? We have another 7 minutes. So what about capital management? Well, as we navigate the unstable world with rising strategic competition between US and China, coupled with conflicts in the Middle East and Europe and trade fragmentation, these risks aren't just headlines anymore. They are impacting and directly influencing the bank's risk-weighted assets, solvency capital ratios, different business lines for insurance companies, their investment portfolios, and resilience strategies. So how do these impact market risk, insurance risk? They have an impact on market risk. They have an impact on insurance risk. For example, for insurance, for instance, wars or sanctions can spike, for market risk, wars and insurance can lead to spikes in inflation through energy surges, for example. They can widen credit spreads as investor confidence declines, and that really causes swings in FX rates. So think in terms of what happened to the sterling during Brexit or the Russian-Ukraine currency during the initial days of the war. Are there any sort of ways to measure geopolitical risk? The answer is yes. So it depends. If you are an insurance company and you have an investment portfolio where you have exposure to different market risk factors, and here market risk we mean the losses that arise on investment portfolio as a result of movement in broad macroeconomic and broad market risk factors such as general interest rate risk, foreign exchange and credit spreads, property and commodities and equity prices. We can use value at risk and stress value at risk models where we can basically apply shocks of these risk factors during periods of heightened geopolitical risks. We can apply those to today's risk factors, do full revaluation and mark to market and mark to model of all the positions we have in these investment portfolios, and then we can generate the mark to market, compare the mark, take the difference in the mark to market of the portfolio between the base scenario and the geopolitical shock scenario, and look at the difference in the P&L. That is one way, but we also can use from general insurance, we can use the frequency and severity. Let's say, for example, you want to put an investment in a particular country, and you want to assess whether this country experienced coups before. So if you have data on the history of coup events, you can arrive at a frequency measure. You can use that frequency measure in a probability, a Poisson probability distribution to compute probabilities of having one, two, or whatever. Then you can use assumptions on the severity. You can generate the loss distribution, slice it and dice it, and you can basically get a measure of your losses contingent on a particular geopolitical event. Or we can use a credit risk approach, meaning that if we have a transaction, we need to compute the expected loss on this particular transaction, given that a particular geopolitical event crystallizes. We can calibrate the probability of default. We can calibrate the exposure at default. We can calibrate the loss given default. We can combine it, and we can also look at what are the impacts. So scenario planning and stress testing. So let's wrap up here with how we can practically integrate geopolitical risks into our frameworks, drawing on from scenario planning and stress testing. So first, we need robust operational resilience, risk assessment and preparation process that allows us to develop those time-aware geopolitical scenarios with propagation pathways. And in order to do that, we need a process. This process requires several stages. First, as an institution, we need to understand our exposures, our geographic exposures. We need to understand the different geopolitical risk events that can trigger losses. We need to understand the geopolitical transmission channels. We need to understand the sensitivity of our exposures to a wide range of geopolitical risk issues. We need to identify the important business services. We need to identify the third-party service providers, who are the service providers, who are the service users. We need to map the interdependencies. So ultimately, you need a cognitive map of the institution with all the dependencies on critical third-party service providers, dependencies on critical infrastructure, and where the exposure are spread. In order to have an understanding if a particular event can impact that exposure. And then you need to set your impact tolerance levels. And this is the maximum amount of disruption that you can tolerate before it sends your institution into chaos. And that means we can refer to it as its own isthmus of chaos. And then you need to identify the impacts, the resources that are needed to conduct this geopolitical risk assessment and preparation process. And then you need a good communication strategy to communicate to the board. And then you need to develop those particular scenarios that takes into account exposure-specific scenarios that are varying in nature, varying in severity, varying in duration, that is aligned with your business model and risk appetite. And this requires a shift in the question from what if a geopolitical event crystallizes to when and how fast the event propagates and how is it going to impact our business model. This requires a shift from static view of geopolitical risk to a kinetic view using motion-aware metrics that takes into account the speed of the event, how it is intensifying, and at what point the cascading impacts overwhelm the institution's response capacity, or that leads to a systemic risk collapse, or what we call the speed of the jerk, the speed of the cascading consequences are greater than the institutional latency. Then we need ways to quantify using different models. We talked about VAR, we talked about stressed VAR, we talked about the tail event, which is the tail of the VAR. We talked about general insurance frequency severity models, and we talked about credit models that you need to calibrate the probability of default. So one model to do that is we use the Merton 1974 model, where we compute the probability of default and you adjust that to take into account default based on a particular geopolitical event in a particular scenario. But we can talk about that later. And all of this needs to be calibrated under stressed market conditions to reflect a wide range of geopolitical risk scenarios. So you have your most likely that reflects the historical narrative, and then you take the optimistic, and then you take a pessimistic scenario, and you look at what you get from that. So finally, enhancing preparedness requires stress testing that boosts through precise model calibration, fostering cross-team calibration and aligning with regulations like Basel and solvency. And then you need to add to that wargaming and fine drills, these regular runs to prepare for the unpredictable or the geopolitical risks that allows you to reduce your downtime when these risks materialize. So to conclude here, these geopolitical insights are the bridge between global events and practical decision making, and they help organizations to answer, what does this particular event mean for our business model and exposure? So when we use these so I think I will stop here. Thank you all for your attention. I'm happy to take questions, and feel free to reach out for further discussions. Thank you.
Thank you very much. Thank you very much, Lawrence. A great topic, a topic that is very relevant in today's climate. So thank you very much. In fact, it's so important that my CPD points that I got today are so relevant. And in fact, the risk flux framework and how you explained all these issues, how geopolitical risks do affect how we do things and how we try to manage our risks is great. It started raining, when you were talking because of the importance of the topic. But anyway, I had my own questions. We don't have time, so I won't ask my own questions. What we are going to do here is we've got 3 questions. So we want to answer those questions live. I am going to read those questions to you, Lawrence. Since we don't have time, we can try to be as brief as we can. We might run over by 2 minutes or so. So the first question comes from Gabo Hanak, who says, would you agree that the recent shift in the nature of geopolitical risk is at least partly the consequence of rising populism by politicians because of their addiction to power and a significantly less interest in populist global players in a cooperative consensus-seeking approach, and their more attraction to a competitive approach where only my interests matter and others do not? So that's the question. Maybe you may want to take that one. Obviously, maybe let me read all the questions. The second question, that's an anonymous attendee. The question is, do the tensions between the US and Venezuela raise any unique geopolitical concerns? Suppose that one is easier, so I will leave that to you. Then the last question was, what type of black swan geopolitical events concern you the most? So those are the 3 questions we have. I will hand over to you, Lawrence, starting with the first, and then we go to the second, and then to the third. Thank you very much.
Yes. I think there is thank you very much, Michael. I think regarding the first question, I'll just keep it brief. There seems to be a shift in world politics into populist movements. We see this particularly in Europe, with the far right in France, in the Netherlands, even in the United Kingdom with Nigel Farage and the Reform Party. But perhaps that's a reflection of really what the people want. So it's something that you need to consider. We don't understand the drivers of it yet, but it's something that to keep track on, to keep an eye on. Regarding the second question and Venezuela, That's quite an interesting, it's interesting question. I think I would like to refer you here to the national security strategy that was published by the Trump administration just a couple of days ago, where they talk about the Monroe Doctrine and the Western Hemisphere. I think over the past couple of decades, there's been some negligence regarding what we call the Western Hemisphere. And according to US geopoliticians, this includes South America and North America and some islands and Caribbean islands. So it looks like this administration, the question is this administration on what's going to come after, they are going to focus on that particular area for security reasons. So Venezuela is part of it. So I would expect probably things to heat up in that particular region. Regarding the third question here, a black swan event. I don't think, okay, so I don't think any geopolitical event is a black swan event, because if we look at the definition of a black swan event, first, it has no history. So if you look back in history, we have no data on it. It has a huge impact and it has a low probability. The closest that I can get to a black swan event is the following. Everything that you do, everything that is on your iPhone, everything that is in your car, in your house, is depending on a signal that is picked up mainly by GPS satellites. And the whole world depends on certain constellations that are divided by the Americans and the Russians and the Europeans and the British and the Japanese. So imagine a cosmological time inevitability or some event in space that knocks out these satellites. It doesn't just stay there, it propagates. It means that from a financial point of view, it impacts high frequency trading. It impacts payment processing. It impacts insurance company ability to process claims automatically. So these kind of events are important to think about because they can be trigger for wider issues. But a geopolitical, to me, I don't see any black swan in geopolitics. I think anything that's come out already, we already know about it, whether it comes from emerging technologies or advanced use of AI or even advanced weapons. So I think, yeah, pretty much that's what my opinion on that. Thank you.
All right. No, thank you very much, Lawrence. There are also some thank yous from Richard Devil. You've got a thank you from Nikki. And then you've got thank you from Carlos. So thank you very much, attendees, for listening to this. The question I was going to ask, because I'm a chairman of a board, I was going to ask this question. You don't have to answer it, but I think that's a question that's top of the mind. How should boards then integrate geopolitical risk into strategic decision-making beyond ICAP and OSA? Now, that's a question maybe for research by attendees, but if you can say something in one line, and then we close.
Well, you need to, there are practical steps to take to achieve this beyond regulatory compliance. So you need to embed it in enterprise risk management framework. You need to basically incorporate it into board agendas and meetings. You need to link it to strategic planning. You need to establish perhaps a geopolitical task force that reports to the board, and it involves leaders from strategy, finance, legal, and operations to monitor risks in real time. I mean, geopolitical risk, and recommend adjustments accordingly.
Thank you very much, Lawrence. At least I've got a tool now that I will take to the next board meeting in 2026. And to all our attendees, thank you very much for listening. And thank you for those who asked questions. We really appreciate it. This is the last webinar hosted by the IAA Banking Virtual Forum. And today we were touching on financial institutions and specifically banks, insurance companies, but it extends to all others like, asset managers, pension funds, and all the other financial institutions out there. So thank you very much. We will engage again in 2026. And Lawrence, to you, thank you very much for sharing your knowledge with us. Please continue staying with us. We really enjoy your presentations.
Thank you, Michael.
IAA,
thank you.
Excellent. To the IAA team, thank you very much, Meet and everyone else, for arranging this and for making it a very good CPD event. So thank you very much. Keep well, everyone. We will meet again in 2026 and enjoy the festive season.
Thank you all. Bye-bye.